Good afternoon. I'd like to get started. My name is Kim Schoenholtz. I'm delighted to welcome you all to the Fall 2018 NYU Stern Economic and Market Outlook Forum. Since 2012, this event has become a Stern tradition at the start of each semester. The host of today's forum is the Center for Global Economy and Business, which serves the university through outreach to the broader community, including the academic, business, and policy worlds, as well as students and alumni. We are especially pleased today to have here students and faculty from all over NYU, as well as a number of Stern alums. Thank you very much for joining us. Today's program will last about 80 minutes. It will begin with presentations of 5 to 10 minutes by each of our panelists about economic and market prospects, followed by audience Q&A. We'll finish by 6:30 p.m. Please note on the screen, thank you. Please note on the screen that you can submit questions to the panel using your smartphone by going to the website www.slido.com, entering the code number 3333 in the box labeled Join, and then submitting your question or voting on others. Your votes will help us judge the issues that are of greatest interest to you. Let me now introduce our distinguished panelists. Starting from the close to me, Seth Carpenter is the chief U.S. economist at UBS. He also has been head of research at Rollcoast Capital. Previously, Dr. Carpenter served as assistant secretary for financial markets in the U.S. Treasury. That followed a distinguished career as an economist at the Federal Reserve Board, culminating in his role as deputy director of the Division of Monetary Affairs. Dr. Carpenter received his PhD in economics from Princeton. Michael Feroli is the chief U.S. economist at JP Morgan. Before joining the bank in 2006, he was an economist at the Federal Reserve Board. Dr. Feroli has consulted with the Joint Economic Committee of the U.S. Congress. Today, he serves on the Economic Advisory Panel of the Federal Reserve Bank of New York and is a panel member of the U.S. Monetary Policy Forum. Dr. Feroli earned his PhD in economics here at NYU.
Never been so ashamed to go to Princeton in my life.
It's far away. Rebecca Patterson is Chief Investment Officer at Bessemer Trust and a member of the firm's management committee. Previously, Ms. Patterson worked at JP Morgan as Chief Market Strategist for Asset Management and as Global Head of Foreign Exchange and Commodities for the private bank. She's a member of the Council on Foreign Relations and the Investment Advisory Committee of the Federal Reserve Bank of New York. American Banker has named her one of the 25 most powerful women in finance. Finally, Ms. Patterson earned her executive MBA right here at the NYU Business School. Sorry, Seth, it's a home crowd. Please join me in welcoming all our panelists. Seth will now begin the presentations, followed by Michael and Rebecca in that order. After their brief initial remarks, we'll begin the Q&A session. Over to you, Seth. And there's a pointer here.
Perfect. I'm just going to keep myself honest.
And they should be able to advance right away there.
Perfect.
Good.
Wow, thank you very much for that introduction, Kim. Thank you, everyone, for being here. It's an honor to be here, letting in the hoi polloi and the rabble from the streets to the august halls of NYU. What am I going to talk about today? So we just have you don't have to read everything, but this is sort of all of what we think about the US economy at UBS in a few simple bullet points. There are two things that I'm going to want to touch on in the 5 to 10 minutes before I overstay my welcome at the podium. The first one is, and it lines up with some of the questions that we got a sneak peek at before. Our view is the underlying US economy right now is actually very, very strong and things are going great, but there is one serious monkey wrench being thrown into the works, and that is trade policy. 2 months ago, we changed our view that we were engaged in a trade skirmish and upgraded that to a trade war. And our view is that that's going to have a massive and meaningful effect on the US economy, and I'm going to talk about that in just a little bit. The second thing that I think is also potentially interesting, and I think I saw it on one of the questions, but it's also on lots of our clients' minds at UBS, is about the Fed and unconventional monetary policy and the unwind of the balance sheet. And I'm going to say something there. I always like to talk about it because in 2002 or thereabouts, when I was at the Fed, my boss came into my office, closed the door, and said, "I've got an opportunity for you to excel," which is bureaucrat speak for shit flows downhill. And it was, you get to be the person over in all of monetary policy at the Fed to be in charge of the Fed's balance sheet. Boy, was that an honor in 2002. Turns out it's kind of interesting now. So I always like to talk about it. So those are the two things that I want to talk about. Our bullet points, though, is trade war escalation is going to slow growth in the fourth quarter. So where are we in terms of trade negotiations? I want you to think about trade and possible trade war in two camps, China and everything else. Right? Everything else is, in our view, more or less a sideshow. You hear lots about NAFTA, and there's lots of ink spilled. It doesn't matter from a macro perspective. You hear a lot about interactions with the EU and automobiles. Our view, the way that is going to turn out, probably won't matter as a macro development either. But when it comes to China, it matters a lot. The current state of affairs is there are tariffs of 25% on $50 billion at an annual pace of imports from China already. But those were very carefully picked to not matter very much. Those are in categories of goods where the US imports from all over the world, and the Chinese share of US imports is 10% or less. The next round, and we think this next round is coming in maybe as soon as tomorrow, but most likely next week for the formal announcement, is on $200 billion. And there, if you rank all the different categories, there are a whole bunch of cats and dogs, but there are a few categories where China is 40, 50, or 60% of US imports. And a lot of those are intermediate goods to production, especially for a lot of manufacturing firms. The tariffs on those are either going to be 10% or perhaps 25%, with the risk to 25% growing every day, given the rhetoric coming out of Washington. And we think that will be sufficient to put a serious crimp on the US economy. In particular, the US manufacturing sector is actually quite strong, underappreciated. Over the past year, manufacturing has added more jobs to the US economy than at any point since the mid-1990s. A lot of those firms are new firms, and notoriously, new firms fail a lot. Census estimates on average that something like 10 to 20% of all new firms fail in the first year because they experience a cost shock that they had not anticipated and they go out of business. These tariffs will be such a cost shock, but more than what is normally anticipated. And we think that's going to cause an abrupt crimp in hiring and capital investment, especially in manufacturing, but there'll probably be some in retail as well. Retail was going through an existential moment last year because of all of the competition from online sales in one form or another. They rebounded a bit with the extra spending from the tax cuts, but they're still in a tenuous situation, so you'll probably lose some jobs there. And we see fourth quarter GDP growth at 1.6%, coming off of 4.1 in the second quarter, 3% we think in the third quarter. So that's a very, very sharp slowdown. And so in terms of what that means, sharp slowdown in the economy, the market, in our view, is not fully priced for it. And the Fed is going to see this. And the way the Fed thinks about the economy is they have a forecast for what's going on, and then they compare the data to what their forecast was. And this slowdown is going to be much sharper than the slowdown that they would have thought the tariffs would do. And so they have to confront the question of, are tariffs having a bigger effect on the economy than we thought? That's a bad outcome. Or is something else that's not even on our radar, in addition to tariffs, causing the economy to slow down? Boy, is that a worse thought. And so in December, when they're making the decision to hike rates or not hike rates, the way the Fed makes these decisions when there's uncertainty is to say, if I hike, what happens if I'm wrong? And if I don't hike, what happens if I'm wrong? Because if you look for the worst case scenario, if they hike, it's predicated on everything being just fine. And if they turn out to be wrong and the economy stinks, they will regret that decision for many a month, quarter, year. If they don't hike, and it turns out if they don't hike, it will be predicated on the idea that the economy is slowing and they're worried. But what happens if they're wrong and everything is just fine? No one will care. Jay Powell is going to give 8 press conferences next year. They themselves only think they're going to hike 3 times next year. So making up for one skipped hike is no big deal. In the 15 years I spent at the Fed, I don't know how many, a couple dozen FOMC meetings that I went to, and that kind of risk management is part and parcel of how the FOMC works. Jay Powell, despite being a relatively new chair of the Fed, grew up intellectually in terms of monetary policy within the Fed. So he thinks about these things very much in a standard mainstream Fed sort of way. So I have no doubt that that kind of logic is also his logic. So that's our macro story. The US economy is strong. Tariffs are going to be a spanner in the works. If, in fact, we get 10% tariffs on the next $200 billion of imports from China, and it doesn't escalate from there, we'd get a hit to the economy in the fourth quarter, but then things start to recover, and we'll go back to roughly where we would have been otherwise, and it will have been a very bad quarter, but the US economy will be able to muddle through it. If instead, escalation leads to more escalation, as is often the case with these sorts of things, we could see an even bigger hit. And in the extreme, if you get tariffs on all the goods and services, which is really just the goods because we don't import services from China, on all the goods and services we import from China, and it's at 25 or 30%, boy, that's probably enough to bring the US economy to a standstill. So those are the risks at hand. I think Wall Street is only just now starting to appreciate how imminent the next round of tariffs is. I think Wall Street has not fully internalized how big the risk is for a further escalation, and that is what we have in store. So that's the first thing I wanted to talk about, and that's the bulk of it. The second thing is a little bit nerdy and dorky, and if I can get to it quickly, I will, which is the Fed's balance sheet. Boy, we went through a massive experiment with monetary policy in the United States and around the world with the expansion of balance sheets. We went from a balance sheet that was about $770 billion, which sounds like a large number, to one that was $4.5 trillion. So this is the expansion of the Fed's balance sheet. On the left are assets, on the right are liabilities. Convenient thing about balance sheets is they balance. Otherwise, they'd just be sheets. Wow. Can I get a degree from NYU?
This afternoon.
So here's what we think this happens in numbers. The last column is where we think things end up. We think the Fed's done unwinding its balance sheet in May of 2020 at a size of $3.5 trillion. What that looks like in pretty charts, though, is the following, and this is the one point that I want to make, and we can get into it in Q&A later. On the top left are total assets on the Fed's balance sheet, so the size of the balance sheet. Went from 770-something before the crisis, if you measure it from Wednesday, August 7th, 2007. That's the starting point for me. Got up to $4.5 trillion, and then it's going to come off, and that's what the dotted line projection is. And what they're doing is they're letting Treasury securities that they own mature without being fully reinvested, and they're letting mortgage-backed securities that they own prepay, which is the MBS fancy word for essentially mature, without being reinvested. And so that's what you see in the top right is what's happening to those asset classes. Now, the funny thing that happens is the Fed's balance sheet is going to shrink and shrink and shrink and shrink until the middle of 2020, and then it will start to grow again. It has always grown since essentially 1914 when the Fed was created till 2007. It will start to grow again when everything is back to normal, and the answer is very, very boring, which is physical paper currency, paper money, liability on the Fed's balance sheet's balance, so if a liability is growing, so will the assets. That fact, I think, is only now getting appreciated widely. The Fed's going to shrink its balance sheet, but then it will start expanding it again, and it will expand it in line with currency. But the amount of Treasury securities that they will buy, and this is my very last point, is something like $20 to $25 billion of Treasury securities each month, starting in May or June of 2020. $20 to $25 billion per month. That sounds like the kind of asset purchase program, or colloquially QE, that some central banks have been doing. And I think that fact, once it fully sets in people's minds, will be a bit of a revelation. Thanks.
I think it's going.
Wait, hold on to the disclaimer, it's great.
The disclaimer is fantastic.
I got a longer one. All right, so I've been doing this forum for several years now, and I actually went back and looked at some of my old presentations. Looked at one from 2013 where we looked at the kind of the economic landscape then, and we kind of concluded as we looked at everything that in 2013 the economy then really still bore the scars of the Great Recession. So I thought, and that was particularly unusual given we were almost 5 years out of the recession to still have a lot of the scars in the economy. So I thought we'd update that and take a look at where we are now in terms of the economy. And the first thing to note is that in 2013, when I was here, the unemployment rate was 7.5%. Now it's 3.9%. So I think it's safe to say that in terms of the labor market, things have definitely healed. That was not the case 5 years ago. So if you're about to graduate, it's a much better forum to be sitting in than then. The other thing that I think is a lot more normal now is the federal budget. At least until a year or two ago, we had seen a pretty good improvement in the deficit situation. That was not, again, the case in 2013 when we still had very large deficits to support the economy, which at the time was still rather weak. Another thing we talked about then was the housing market, which in 2013 was still quite depressed. And that was pretty important because housing was at the center of the Great Recession. Now housing has pretty much recovered. It doesn't look like it's recovered, but the demographics are different than they have been in decades past. And I think when you adjust for that, most people would say housing market is now back to normal. And then finally, the last thing we looked at back then was equity markets and financial markets in general. Whether you were looking at price-earnings ratios or the equity risk premia on the right-hand side here, there was still a bit of fear evident in equity markets. And in fact, at 2013, the equity risk premia was at the very peak of that chart on the right. So I said at the time, equities look cheap. There's a record of that, Kim, so I'm not just... what you did with that information, is up to you. Now, arguably, equity risk premia is still somewhat elevated, but not nearly as elevated as it was then. So all these things that we discussed in 2013, which still bore the scars of the recession, now look like they have fully recovered. So I think it's, in one sense, you could say things are back to normal. On the other hand, if you look at some other, just sticking with the topic of equity markets, if you look at skew in the S&P futures, they indicate that there's still a lot of concern about downside risk, actually record levels of concern about downside risk. If you look at household behavior, what I've plotted here is a little bit, take some time to talk through. What I have plotted is basically the blue line is net worth, the wealth to income ratio. And so this is how wealthy households are relative to how much they make. The orange line is the saving rate. It's inverted. And generally what happens in the past is when wealth goes up, i.e. when stock prices go up and house prices go up, people feel more comfortable reducing their saving rate. What you've seen lately is a kind of a breakdown in this relationship. So we've had great equity markets. We've had house prices go are doing very well, and yet saving rates remain relatively elevated. So households seem to be unconvinced or just more cautious than they had been in the past when it comes to this wealth that we've actually generated over the past several years. So consumers seem to be a little bit more cautious. And then finally, if you look at business behavior, I don't know what happened to this chart, but you can still get the idea, which is the orange line is corporate profits as a share of GDP or GDI, roughly the same thing. And the blue line is business investment spending as a share of GDP. Now, in the past, these two tended to co-vary. And I'm not saying this is the perfect model of capital investment spending, but generally thinking it's not too unreasonable to think that when profits go up, firms are going to want to invest more. And what we've seen lately is a disconnect. For whatever reasons, firms seem to be a bit more cautious about or reluctant to invest these profits. So what I would conclude, and again, I guess this is more of a big picture view than Seth's kind of more near-term outlook, is at least compared to when I was here in 2013, the physical scars, if you will, of the Great Recession have healed. Right? So unemployment is down, spending seems to have recovered, fiscal position is in better shape. But in some ways, the emotional scarring is still present. And I think you see this in a number of behavioral shifts. And how long those behavioral shifts persist, I don't think anyone really knows. But I think coming back to this issue of the saving rate, I think what we do know is that people who lived through the Great Depression, their saving rates remained elevated generally for the rest of their lives. So I think people who lived through the Great Recession, I think you probably will see behavioral shifts that persist probably for quite some time. That's it.
lots of buttons. Green?
Green.
Green means go. Love it. I have less disclosures. Great, so I don't want to duplicate what's already been said extremely well, so what I'm going to try to do is go very quickly through US thoughts and then do a little bit more of a global tour and also take where we left off with monetary policy and the economy and a little bit more into market implications. And I think at the end of the day, the economy drives the markets, but the markets can also influence policy and the economy. So I think it makes sense to be discussing both. There's look at that, it's so little. It's great being on the buy side. Okay. So first quick comment. First quick comment, don't worry about the numbers here, and if you're colorblind, my apologies. This is a heat map looking at business confidence surveys, and we focus on them a lot because they tend to be generally leading indicators of actual economic activity. And what you see in the red box is a period of time where we had very synchronized global growth. Almost every country producing a PMI, a business confidence index, was above 50, i.e. the economy was expanding. Now when we get to the last few months, partly because of trade, partly because of some EM shocks I'll talk about in a minute, you're seeing a little less synchronization, and that helps explain why the US equity market is outperforming the rest of the world so much a bit. And it also has impacts on companies. If you're a big US multinational, obviously, if you have synchronized global growth, you're going to be getting revenue from more sources around the world. So synchronized, non-synchronized does matter. But overall, the global economy is doing fine. If you look at the August PMIs, which just came out, and thanks to JP Morgan, because they put together a really nice all-industry PMI aggregate, it suggests global growth is still growing around 3.1%. Now, while we're staying on a happy note, because I'm going to get dark in a few minutes, so those of you who are legal can go out and have drinks when we're done. But I'm staying happy for a moment. So we're Goldilocks still. So you have decent global growth led by the US, which in turn is led by deregulation and fiscal stimulus. And then you have this gorgeous picture on the left, which is inflation, which is positive but still very much under control, which means that central banks can go gradually. So financial conditions don't tighten too fast. They don't choke off the economic expansion, and they don't hinder equity markets. So this is a good thing. And I have lots of clients who come in and say, why is the market up? The market should be down. Trade wars, anxiety, op-eds. But at the end of the day, it's not the rhetoric that drives the markets. It's the underlying economy that does. And the underlying economy is about as good as it gets. You have strong global growth, and you have tame inflation. All right, that's the end of my happy notes. So when I think about how to invest my clients' capital, I'm looking a lot at the economy, and then I'm always thinking, kind of like Seth mentioned with the Fed, what can go wrong? You know, it's risk management. And there's such a long list right now. There's always a long list. But I wanted to touch on a few, and I'm anxious to be making any comments about the Fed in front of this little group here. But one of the things that you're reading about a lot in the press, comes up a lot, is the curve, right? So on the left, you have a chart. You can see that we're nearing inversion. And I can promise you, as a former journalist, that the day we invert, every newspaper, every business TV channel is going to be going absolutely batty over this. They're going to be screaming about it. The end is nigh. Get out, get out, get out. So just a friendly reminder that there's a lot of dispersion around inversion as a signal and an actual economic influence, and when the world turns, and it got cut off here. Ooh, so it's kind of like a puzzle. The bottom line is that historically, if we go back to the 60s, after the curve inverted, you had usually another year before the equity market peaked and another half year or so before the recession started. There's, again, though, a lot of dispersion around that, and every cycle is different. I think you had Williams talking today up in Buffalo about this and saying the curve isn't a big deal. It is different this time. So it's an important signaling effect, but it doesn't mean you need to jump out of the pool right away. The balance sheet, you know, Seth talked to, and Michael both mentioned balance sheets, Seth especially. I love your 2002 story. And this is a tough one. I mean, the New York Fed committee that I'm part of, we spend a lot of time saying, well, how much does this matter to the equity market? How much does this matter to financial conditions? And we don't really know because we don't have a lot of experience with this before. The chart I'm showing you is just the balance sheet, and this isn't just the Fed. This is the Fed, the European Central Bank, and the Bank of Japan, and it's a leading indicator for global equities by a year. But to me, that's kind of intuitive, right? If you are draining liquidity from the system, if financial conditions are getting tighter, there should be some effect. To me, the question is just how big of a deal is it? And I think we're going to know sadly, in this case, in retrospect. There's a lot of great academic work predicting how much it matters, but I think we'll find out when it happens. But it's another risk to watch, medium term, not imminent. Trade we touched on a little bit. To me, the trade war is, when do we see it in the data? And just now you're starting to see a few bits and pieces. You've got German manufacturing orders. We just got new data on that out this morning. It was actually worse than expected. And Germany is 50% exports. If you're seeing their manufacturing sector hit and exports hit, it's going to affect their overall economy. In the US, it tends to be in sentiment more than actual data at this point. But if Seth's right, and I really hope you're wrong on this one, I'm sorry. But if he's right, we're going to see it start showing up in those PMI surveys, probably more in some of the PPI, the intermediate inflation numbers in the coming months. And that certainly could affect equity markets. Our own view is that the longer the uncertainty lasts, the greater a probability that it feeds through to the economy. And you are seeing it in CapEx already. People are deciding to buy back stock rather than invest, in part because of the uncertainty, in part. So going overseas for a minute, if we want more to be scared of. So we have this lovely Italian government. Full disclosure, I lived in Italy in the 1990s, and as a journalist followed Berlusconi around when he first ran for office. And I will go on the record saying he didn't hit on me. I wasn't his type. Darn. So my point here is that we have a new government in Italy formed by the League and the Five-Star Movement, very populist. They aren't quite sure what they're doing yet. Are they going to have fiscal expansion or not? If so, how much? What's unnerving the market, and you see it in their 10-year yield starting to rise, is that they're talking about some fiscal expansion, which would go against the Growth and Stability Pact in Europe. Right now, it's not a big deal because the ECB is buying all their debt. And you can see that in the chart on the left. But as of January next year, guess what? Quantitative easing in Europe comes to an end. They stop buying assets. What happens to Italian bond yields then? How does it feed through into their equity market and their broader economy? I don't think the market's giving that enough credence. It's possible this new government won't go that route, but if they do, it could get nasty around the end of the year in particular. EM, we've got two issues here, cyclical and idiosyncratic. On the cyclical side, as the Fed raises rates, all else equal, that tends to lift the dollar. Currencies trade in pairs. If the dollar goes up, other currencies go down. It's pretty easy. So you have the Fed raising rates, dollar goes up pretty much against everything. So that's the cyclical. The idiosyncratic, there's a whole bunch of stuff. There's inflation overshoots in places like Argentina. There's policy uncertainty in places like Venezuela and Russia with sanctions. There's countries with large current account deficits that are oil importers. Brent crude is back to its highest levels this year. Places like South Africa, Turkey. And so you have these idiosyncratic and these cyclical elements coming together. And the result is a good old-fashioned EM crisis that we're starting to see play out. Argentina raised interest rates to 60% last week trying to fight this. It hasn't worked yet. The chatter in the market right now is that Turkey's going to raise in the next few weeks 500 basis points. It's not helping. This is a problem for economies because as you get weaker currencies, it passes through to inflation. The central banks react by raising rates to try to stabilize inflation. Higher interest rates choke off the economy, which makes investors not want to be there, which weakens the currencies more. And you get a little bit of a death spiral going. I don't think we're done. Turkey in particular, I think, is underappreciated, not because of economics, but because of geopolitics. Remember on the map where it lies, right? You go over the bridge in Istanbul, it's east versus west. It's also north versus south. So if Turkey's economy implodes, you've got a whole bunch of problems there. You have NATO bases, you have US Air Force bases. Erdogan is threatening the US bases. Turkey has promised the EU it won't let the migrants through if they get 6 billion euros. They've only gotten 3, reportedly, and they're now threatening if they don't get financial aid that they might open the gates again. That was fine in 2015, but it's not fine today. We have an election in Sweden this Sunday, and there is a good chance you're going to see a populist, far-right, anti-immigrant party get more seats than it ever has before because of this issue. Turkey has a lot of leverage right now. If they don't get the help from Europe, they could go to Russia and Iran for it. Europe doesn't want to see Turkey go that way. I would pay a lot of attention to this one. Last but not least, I told you I was getting dark. So at the end of this year, November, we're going to get the sanctions on Iran fully implemented. And oil prices are starting to go up now in anticipation of that. Terrible time of year for people to have to pay more to fill their tank because they want to buy holiday gifts for their family and friends. And so you can see oil, obviously a big chunk of overall consumer prices. So oil will lead CPI, which affects the Fed's thinking. At the same time, and I apologize, the chart on the right is a little hard to follow, but trust me when I say that higher oil prices on average will tend to weigh on consumer sentiment, and it hurts consumer spending. A lot of Americans spend a good chunk of their disposable income filling their tanks and heating or cooling their homes. So if we see oil continue to go up on Middle East, because Turkey makes the Middle East, North Africa situation worse, Iran implementation is stricter than expected, this is another shock that could affect the US and affect the Fed's thinking, because it would be stagflationary right at the turn of the year. I'm going to leave it there, and we can say more happy thoughts during Q&A.
Great, let's thank everybody. Thank all of you. That was great. So now our panelists are ready to answer your questions. So I'm going to ask everybody, once again, to go to slido.com, slido.com, join at 3333, that's our event. And enter your questions and vote on the questions that are there. And unless the questions have already been answered, and some of them have been in the discussion we've had, I'm going to be led in posing those questions by the ones that you select. So audience participation matters today. Let's start with Paul Wachtel's question. This is a bit of a long-run question, but it's a question about the labor market. Wage growth in the United States has remained rather low, despite the fact that the unemployment rate's below 4%. How do we explain this? What's causing this pattern?
Well, I think
You lead.
one thing I would say is that you would think that normally in an economy operating at full employment, where everything is humming along nicely, is that wage growth should equal the sum of productivity growth and the inflation rate. Inflation rate should be around 2%, and it is lately running around 2%. So you'd say normalized wage growth should be 2% plus whatever the growth of productivity is. I think when a lot of us grow up, we thought growth in productivity should be running around 2.5%. So normal wage growth should be around 4 to 4.5%. Over the last 5 to 10 years, productivity growth has been more like 1% at best, if you find the right comparison. So that might argue that in this kind of new normal regime where productivity growth is slower, that normal wage growth may be more like 3%. Right now we're running 2.7, 2.8, depending which measure you look at. So we're still underperforming, I think, what we should be doing, and particularly since the economy is probably operating a little bit beyond full employment. But maybe we aren't undershooting as much as we would think, given a mindset that was formed a few decades ago.
Anybody else?
Yeah, so I completely agree with Mike's characterization that part of the vast majority of the puzzle, but not all of it, is that people tend to be comparing wage growth to the wrong measure. So people, when the variation that I get as a question is, the last time the US economy had an unemployment rate of 3.9%, wage inflation was much higher. Boy, aren't we missing by a couple of percentage points? And the answer is, in large part, no, for the reasons that Mike posited. So the puzzle is much smaller than it first appears. I would add to that, part of the resolution of the puzzle is a slight difference in the take on the data from Mike's statement that the labor market has fully normalized. Just there are still more people who are working part-time who would rather work full-time than there had been in the past when the unemployment rate was this low. So part of that scarring, I suspect, is still there. Moreover, the unemployment rate is a reflection of how many people have jobs relative to the labor market, but one also has to consider how many people are choosing to be in the labor market, or more importantly, when the survey from the Bureau of Labor Statistics comes around, check the box that says that they're in the labor market. And what we have seen over the past 2.5 to 3 years is that people between the ages of 25 and 54 years old have actually been increasing their labor force participation. So whatever measure of the unemployment rate one has in mind, it may be in fact overstating just how tight the labor market is, or overstating how far back to normal we are. And so I think those other bits go a reasonable ways to explaining the puzzle. And then we've just been in this very, very low inflation environment for a while, and people are a little bit afraid to ask their boss for a raise. Raising your hand saying, hey, I'd like a raise, is also raising your hand saying, if you need to fire somebody, I'm right here.
I'm good.
Good, okay. President Trump has been criticizing the Fed for hiking interest rates. If that criticism continues, this will run counter to Seth's expectations for Fed policy later this year, but if that criticism continues, how do you think it'll affect financial markets and the economy and the Fed?
I love studying history, and if people are into this, I would highly recommend, there's I believe it's a New York Times article in their archives that talks about President Johnson. And that was the last time we saw a Fed chair criticized in this manner. And if the reports are to be believed, and this is more hearsay than factually confirmed, but there was a point where the president might have, at his ranch in Texas, actually physically touched him, not in a happy, friendly way. So it doesn't happen often. I'd say where you do see it happen overseas, it absolutely does affect financial markets. I mean, you look at Turkey. In this case, Erdogan has basically made a relative in charge of policy, and he's not letting him raise rates so far. It's not going well. Where you see a lack of independence between the Fed and the government, it doesn't tend to end well. I think right now, because of the president's pattern of commenting frequently and often changing his view, the market's sort of looking through it and believing it's more of the same. It's just bombast. It's not something to really worry about. But if it were to continue and the threats grew, it might be, and it's certainly not positive. I think the Fed will do whatever the Fed thinks is right regardless.
Anybody else? Yeah?
I'd just add, for those who aren't familiar with the institution, that the people who run it cannot be removed by the president, right? And they have very long terms. So this could be a lot of noise, but the substance, I think, is going to be not much unless the market makes it substantive. Mm-hmm. So the people who are in there, the president cannot fire. He can tweet about, but that's about it.
So the message is, if Jay Powell gets invited to Mar-a-Lago, he should think twice.
Exactly.
Okay.
But the other message is, if he gets invited to Mar-a-Lago, I think the effect on the Fed to 2 decimal points is 0.
Yeah.
Okay. So what do you think are the economic effects of the White House tightening immigration policies, both short-term and long-term?
Yeah.
I guess the only thing,
No, please.
the only thing I would add is that I think, it's obviously hard to measure undocumented immigration for obvious reasons, but I think most measures we have suggest that it really flattened off quite a bit in 2008 and has been very marginal since then. So it may be a lot less than, first of all, it's not clear he's actually done anything or is able to do anything beyond, what he can do by executive power. But even if he were to do something more, it's not clear that's going to have a big effect on labor supply. Prior to 2008, undocumented immigration had been a big source of labor supply and growth in the workforce, but that really hasn't been the case over the past 10 years.
So I would agree with that. I think the bigger issue is more what goes on with the immigration reform debate more broadly. So there was, I'll forget, 5 years ago, 6 years ago, a bipartisan bill that passed the Senate to reform immigration, allow more immigration in, especially among higher skilled, higher trained workers. And the CBO score of that was that it would raise potential GDP growth by 0.3 percentage point. One can quibble with all sorts of details of the analysis, but nevertheless, 0.3 percentage point on potential GDP growth, 0.3 percentage point or anything remotely like that, essentially in perpetuity of faster growth, is a massive increase in the general well-being of the United States. And that's what we're leaving on the table.
And just anecdotally, I'd add that some graduate schools, not this one, professors and administrators I've talked to have suggested that they're now losing extremely well-trained immigrant students who are going back to their home countries because they feel less welcome. I think there can be, over time, an economic impact from that. And if you think about immigration policy abroad, part of the reason China's loosening up on its one-child policy is they desperately need population to underpin GDP. And without having the population growth, because it's not going to change quickly enough, they have to rely on other sources to boost GDP, which either is capital stock, which is debt, which is an issue, or it's Made in China 2025. It's a technology-focused industrial policy. They have to do this because they don't have the immigrants or the domestic population. And that's where we could be headed.
The next question is about the big risks in the emerging markets. And Rebecca, you touched on that a lot, especially about Turkey. Did you want to expand perhaps about other parts of the emerging world that might be worth looking into in a little bit more depth? Argentina is an example. And just a couple of years ago, people used to look back at Argentina and say this is a model of how you're supposed to behave, a government that was aiming at structural reform, and yet they're in a crisis raising interest rates to 60%. How do you manage that?
Yeah. I mean, as a rule of thumb, I try to invest or focus on emerging markets that have current account surpluses or very small deficits, and that don't have huge policy issues. I prefer countries that aren't completely cyclical, tied to commodity cycles, unless you're being thoughtful when you get in. And you also want liquidity. You also want to look at foreign holdings of local assets. So a country like Indonesia right now, one of its challenges is that I'd say probably more than 50% of its local debt today is held by foreigners. And so when foreigners get spooked and they take the money out, the markets are so illiquid that it has an exacerbated impact on the underlying markets, which can cause the currency to fall and that spiral to happen. So a lot of it is sentiment driven. If Americans are feeling confident, if foreigners are feeling confident, they put money overseas. When they get nervous, they bring it home. I think the whole ETF phenomenon has exacerbated that, right? Because now you have more and more ETFs, which are an EM ETF. And so you have money that flows in and flows out en masse, even if there are underlying companies within those countries that are very, very sound. And that can make the problem faster and more exacerbated. I don't know if this is going to have contagion back to the developed markets. I think that risk is greater if the trade war gets worse and or when the fiscal stimulus in the US starts to wear off. And I don't have a strong view if we see the stimulus impact wearing off in 19 or 20. Part of it, I guess, will depend on the interplay with the trade war. But this doesn't feel like, I lived in Singapore right after the Asian crisis. This doesn't feel like that to me. But because the holdings are not as big, you haven't seen as much flow go into emerging markets this cycle, so there aren't as many positions to leave. But it certainly can have a feedback loop to the US. The one to watch is China. China's it's basically EM and China, even though China is an emerging market. And they're subsidizing as much as they can to get through this trade war. If they can hold up with GDP relatively steady, I'm not so worried. If you start to see China cracking, then we're going to have a much greater risk of a global recession.
Okay. Well, the next question is about a Fed-induced recession, but let me broaden that and just ask your judgment. How do each of you see the odds of a U.S. recession over the next 2 years?
So our take on it has been evolving pretty heavily with the trade war. So as the probability of full-blown trade war, tariffs across everything we import from China, the probability of a recession from that source goes up. If we can abstract from the trade war side of things, we thought there was some meaningful probability of a recession in 2020 and probably going up a bit in 2021. And the logic is we have the fiscal impulse starting to come off a bit at the end of 2019 and then very sharply in 2020. And anytime you see an economy decelerate very rapidly, it leaves itself vulnerable to other shocks. So just the unwind of the fiscal stimulus in and of itself, in our view, was not going to be enough to cause a recession. But then suppose against that backdrop, something else happens. So bad things happen to good economies all the time. I'll actually quibble a little bit with the role of oil prices on the U.S. economy. Absolutely, higher oil and gas prices are a drag on the U.S. consumer. That I don't disagree with in the slightest. However, the U.S. is now one of the largest oil producers in the world. The amount of production in the U.S. is going up at a staggering rate. And all of the increase in investment spending in 2017 that we saw came because of the energy sector. As long as oil stays above $45 or $50 a barrel, there's going to be a net boost to the U.S. economy, unless and until it gets above something like $125 or more a barrel, in which case the drag on the consumer is going to outweigh. And the drag from the consumer is real, but the boost to investment spending and the boost to extra employment from the energy sector is not to be underestimated. We think it's adding something like 35 basis points of real GDP growth this year.
Okay. Mike?
So we've been hearing a lot about the 2020 recession, as people have been calling it, and I think it's a reasonable story that the economy, labor markets are tight, the Fed's going to have to keep tightening, and then that's usually how things go into recession. That being said, the Philly Fed has been surveying professional economists going back to the 1970s. One of the questions is, what is the odds of a recession in the next 12 months? And they've never gotten it right. Those odds have never gone above like 30% 12 months before a recession.
So we're professional economists.
So to think that we're going to get it, if we've never gotten it 12 months ahead, that we're going to get it 24 months ahead, I think we should treat these with some humility and some skepticism. Again, I think the narrative makes sense, but we're not great at forecasting recessions. The other thing I'd note is that there's no sort of cosmological constant that says the economy has to go into recession after a certain number of years. A lot of people have recently been pointing to the example of Australia, which is in 27 years or something of expansion. Now, what they have had is a period of two basically soft landings, slow downs, the pause that kind of refreshes. It's possible that we could have something like that here. I don't know. Or it's possible we could have a recession in 2020, but we're not trying to push that with too much confidence.
And I have the view that at the end of the day, the equity market is heavily tied to the economic cycle. And so while I agree it's almost impossible to predict when the recession is going to start, I think if you can get close on the probability and you see the probability rising, there's a greater chance equities are going to roll over. And if you have equities falling 15, 20%, the sentiment shock can take you into a recession. So we spend a lot of time trying to understand the probability of a recession over a certain period. Most institutions, I'm sure both of yours, the Federal Reserve, everybody has probability models for recessions. Ours is now saying over the next year and a half about 60%. We haven't seen 6-0, but that's not surprising, right? I mean, if the Fed continues tightening, the curve inverts. We're at full employment a year and a half. That's late 2019, early 2020. So yeah. But what we've seen historically is equity markets didn't tend to roll over till that probability got to 75 or 80%. So 60% might sound high, but historically it wasn't an inflection point.
Okay. Well, actually, it's related to a couple of other questions that are out there. The most popular one is, how long do you think the bull equity market is going to continue?
April 3rd, 2019, 2:30 in the afternoon.
You can sell the equity market forward exactly on that date.
I mean, we wish we knew.
But why would it wait till the afternoon?
I don't know. I just made that up. I mean, but that is what, I mean, it's such a silly question. It's not a silly question. I appreciate whoever asked the question, but no one knows. Again, the world is not that easy. If it were, there'd be some really successful people out there who would own islands. It's all about probabilities. And you look at valuations, you look at flows, you look at the underlying trends in the economy and policy. And when you feel the probabilities are tipping or not, you probably should take some money off the table.
I think that'll do. Very different kind of question. In this university, we spent a lot of time teaching people about data skills and using all kinds of new techniques to access big data, a variety of data. To what extent are you finding it useful to use unusual data sources, broad data sources, in the work that you're doing and looking out?
So I want to just jump in on data, whether it's big data, alternative data, or not, and first just make a point, and this might actually resonate with Dick, who used to run the Office of Financial Research. So one of the hats that I wore at the Federal Reserve is I ran the entire Federal Reserve System statistics and reserves function. So all of the collection of data from all of the banks in the country get processed, and the reason that I was in charge of it is much like the earlier story I was talking about the balance sheet. I was the only one around that day. But one of the things that I would frequently tell the analysts, so at each of the 12 reserve banks, they had statistics functions where there were analysts getting the data in, and they would run edits over them to ensure the validity of the data. Do these make sense? Do the balance sheets balance? Is the change in this category larger than anything we've ever seen? Call the bank back and get quality assurance on the data. And so, but then they'd hit send, it would go off in the ether. And so part of my job was to buck up the spirits of everybody. And one of the things that I tried to tell them to understand what they were doing and why it mattered with data is that there is the job that they're doing, and then they're checking to make sure the data are accurate, and they're checking with the banks that submitted the data to make sure they made any sense, because there's a massively important distinction between data and information. And so the best example for me that I would always give these analysts to show why what they were doing was important is that as we got into the beginning of the financial crisis, which I date to 2007, not 2008, there were all of these stories and anecdotes about a credit crunch, about banks pulling back on access to credit and lots of firms not having access to credit. And there was a series of articles written, some by otherwise highly respected and respectable economists, saying that is just complete hogwash. Look what's going on with C&I loans, with business loans. They're actually running up, they're booming. Well, as it turns out, all of the staff around the Federal Reserve System who collect these data from the banks who submit them called the banks and said, you know, this is going up more than we would anticipate. What's going on? And the answer was, well, we had a bunch of contracts with our customers where there were pre-committed lines of credit. They never used them before because, boy, were they getting credit everywhere else. And the only reason they're coming to us is because they can't get credit anywhere else. And so you saw this surge in business lending precisely because other forms of credit were no longer there. And so if all you're doing is looking at data, you may well be missing a huge amount of very useful, important information. I think the same sorts of lessons need to be applied to big data. I think they can be incredibly helpful if you know what you are looking for. And so anytime you ask a student, hey, go get some data and then compute this summary statistic, you will get an answer. Boy, isn't it important to know what that answer means.
Yeah, we've actually been using big data now for a few years. There's JP Morgan Chase Institute, which has access to, Chase is obviously a very large retail bank that has, I think, 40-some million customers. And so they're using that data to better understand trends in the economy. For instance, what happened to consumer spending after Hurricane Harvey, because retail sales data we only have nationally. So we can use some of that data to kind of drill down and get a better look at those things. So we have found some promise there in terms of some of that.
And I would just put in a plug, because all the data that they have is made publicly available. And it's clean data. It's interesting to play with.
Cool. Rebecca made the point about the yield curve attracting a lot of attention on the day that we hit flat. To what extent, let me pose this question a little differently. To what extent have you downgraded the importance of the yield curve in your judgments about the economic outlook and the market outlook?
Sure. So one of, part of my dissertation thesis here at NYU was on the information content of the yield curve as a predictor of future output growth. And even back then, and I wrote that in 2002, there was already evidence that its power was diminishing somewhat in the 80s and 90s relative to prior decades. So I think it's already been perhaps not quite as informative as it had been in the past. There is this other issue regarding a decline in term premia, which is basically how much extra compensation you get paid to hold longer term debt. That may be messing with the signal a little bit. That said, we definitely don't want to totally downplay it or diminish it. And I think what it's saying is something pretty obvious, which is that this cycle is not young, right? Mm-hmm. It was maybe in 2013, but it's not now. And so I don't think it's inconsistent with, I think, most people's common sense intuition. I think when it does invert, then you're going to have to say, is that some sort of critical point, or does it have to invert more so than it did in the past before we really get worried? And I think that's an unresolved debate, but a pretty vigorous one right now.
My general answer is I can't dismiss it outright. On the other hand, most of the historical evidence is essentially drawing conclusions off of a small handful of observations without being able to control for everything else that's going on. So if we get to a point where the yield curve is 5 basis points steep or negative 5 basis points inverted, sure, are we looking at the real data? And if I get some negative signal from the real data, I may pay more attention to it. But if the yield curve is inverted by 5 basis points, and we're printing 300,000 new jobs a month, and investment spending is accelerating a bit, and consumption spending is holding up at 2.75% to 3%, I'm not going to take that as an imminent sign of recession. And moreover, just something to keep in mind when people say, look, every time the yield curve has inverted, we've had a recession. It's also the case that every time the economy has been in expansion, it's been followed by a recession. You can look that up in the data. So whenever there's an expansion, just be really cautious because there's a recession coming.
I would just quickly add that one thing that I think is new this cycle relative to the past is the influence on global flows on the long end of the curve, because we have had negative interest rates and QE around the world, and you've had more investors in other countries trying to put money here in the US to pick up a little extra yield, and that has pushed down the long end of the curve perhaps more than has been historically. And so it's a different, every cycle's different, but that's one of the influences that this time around is relatively new and much more pronounced. It's not new, but it's much more pronounced this time around. So to your point, yeah, there's meaning there, but you don't want to overemphasize it.
I'll just add a quick anecdote. I'm old, so I'm reminded of the Greenspan conundrum of 2005 when he was worried that the Fed was raising interest rates, but long bond yields hadn't risen for at least a year and a half, so the yield curve was flattening. And I think at that time, if you'd looked at a whole variety of financial conditions, equity market conditions, yield spreads, et cetera, you would have found that the yield curve was the anomaly. It wasn't a really clear indicator, even among a whole variety of financial conditions, leaving out the real economy. So I'm sort of careful about it. Okay. FinTech is a big subject here at NYU, at Stern. And the question is, to what extent is FinTech and AI likely to continue to shape or reshape the financial industry and maybe the broader job market?
So my take on that, so when I was part of the administration, there were lots of work streams, policy streams being done on FinTech. My view then is, like now, only a couple years in the future, which is in 5 or 10 years, no one's going to talk about FinTech. They're just going to talk about the financial services industry. They're utterly and completely inseparable, in my view. Well over 90% of the transactions that take place in the on-the-run treasury market, so the market for trading the most recently issued treasury security, is done electronically. So there is no distinction. Almost the entire sort of most recently issued treasury market is electronic and financial and taking place at the speed of nanoseconds or faster. So I would take the question and say you didn't go anywhere near far enough. It matters. It will continue to matter more and more. It will matter so much to the point where it will be indistinguishable from just every part of daily life in the financial services industry.
I totally agree. I was actually shocked to learn that my company now employs more programmers than Google does. So I think tech and finance are, very much one and the same right now.
And I don't think it means that there aren't jobs. They're just different kinds of jobs. And it doesn't mean everyone here has to code, although it's certainly helpful to understand it. I also think it means that EQ still matters, or perhaps even matters more, because you have to take the data, you have to take the results, be able to explain it to someone on the other side of the table from you, and understand what they're trying to achieve, what their problem is, how can you help them. And so I think there is a role for humans here, even in this advanced technological age.
Let me just extend that a little bit. The last decade has seen a really big increase in regulation and compliance costs in the financial industry. To what extent is technology helping to cut those costs? Reg tech, so to speak.
My sense is it's not there yet. When I think about, and I hope I'm not airing dirty laundry, when I think about some of the interactions with clients, and so our salespeople are trying to get more business with our clients, and they dangle the shiny object, which is the chief US economist. I'm like, oh, so how much do we trade with that person? And the answer is very frequently, and I'm curious if you have the same thing. Well, it will be a lot soon, but we're still sort of signing all of the documents to make sure that we have all the regulation in place. And if you take a good-sized hedge fund, it's not an entity. It's a bunch of different entities, and they have different funds. And to be able to do transactions across different ones, then each investment bank has to have an agreement, has to have a document signed with each of the different individual ones. And then depending on the securities being traded, blah, blah, blah. And then you multiply that by all the different investment banks. That still seems to me to be a borderline inscrutable sand in the gears for the financial services industry. So I don't think we've seen anything like what it's capable of.
Okay.
One thing I'd just kind of add to that is, at least when it comes to standalone fintech, one has to be cautious as to the degree to which it's just regulatory arbitrage, right? Before fintech, we had financial engineering. That's now a dirty word. But they're very similar sounding, actually, if you just say them. But I think we now realize that a lot of financial engineering was raised to get around some of the capital constraints that were being imposed. So I think that's something that I'm not sure that the regulators are well prepared to address, but it is something I think that we should be thinking about.
Okay. This one's about the U.S., I assume it's the federal deficit and debt. To what extent or is the debt likely to affect the U.S. economic growth prospects?
Boy, there's so many really simple models that give you a very strong conclusive yes to that. The deficit is galloping higher and higher and higher, and yet longer term, 10-year rates are still at 2.9, so it hasn't shown up through the normal crowding out method that most people would think about higher interest rates leading to less investment spending. Moreover, the short run, long run version of those sorts of things is always a bit confusing. Lots of basic models will tell you that expansionary fiscal policy, which pushes up the deficit, also can stimulate the economy. So you have a short run versus long run trade-off. I think the things that I worry about most are twofold for the near to medium term. First is, we were talking about EM before, and I'm firmly of the view, and I think our strategists are of the view, that part of the stress that you're seeing in EM, by no means all of it, because I think the fundamentals are absolutely clearly there, but the US Treasury Department is issuing a lot of debt. It's issuing a lot of short-term debt as short-term interest rates continue to rise. And so if somebody is thinking about where to deploy capital, you're looking at emerging markets where you used to get a much higher return relative to super safe US Treasury debt, and now that return differential has diminished. And in risk-adjusted terms, boy, that differential has probably diminished so much that it may even be going the other way. And so this very large increase in super safe, super liquid debt denominated in dollars is probably contributing to the stress in financial markets, in emerging markets. I think the other place where I'm a little bit worried is cyclical behavior and the inimitable wisdom of the US Congress. So if you think back to 2009, there we are facing the worst recession since the Great Depression, the worst recession literally than anyone alive at the time had ever seen. And we were able to muster the political will to have a stimulus package of $780 billion. Boy, we have to be fiscally responsible. And then we got to the expansion that was kind of weak, and we went through this need for fiscal austerity as a political artifice to sort of rein in government spending. And so now, when the political winds shift and we blow up the deficit, what I'm worried about is the next time we end up in a similar situation, those very same cries will be given lots and lots and lots of credence by lots of very respected and respectable mainstream economists who say, well, the deficit is going to have bad long-run effects on the economy, so you can't expand the deficit, and it will be the reason why, once again, we will have not counter-cyclical fiscal policy, but pro-cyclical fiscal policy, making the recession worse and making the expansion less robust.
Great. Anybody else? Okay. I think it's 10 years ago today that Treasury put the Fannie and Freddie into conservatorship. And it's only 10 years plus, well, a little less than 10 years since Lehman failed. So the question is, are we in a safer place today? Can we withstand shocks that were as big as those and not suffer the same kinds of consequences?
I think they're safer. I think the banks are a lot safer. I mean, the regulatory crackdown was large. I mean, you all have hired thousands of compliance officers and done a lot with your capital. So that's a good thing. I think the consumer is safer, and we saw that in some of the charts earlier. Where I constantly look for where are the excesses, where are the vulnerabilities, and I think the IMF has done a nice job with this in its Global Financial Stability Report, is the non-financial corporate debt. And we're seeing non-financial corporate debt back up to pre-crisis levels. We're seeing covenant-light loans back again. We're seeing all those same sorts of behaviors. And to me, in a surprisingly large amount of US companies today, they're barely able to make current interest payments with current revenue. And that's before the Fed hikes 3 more times next year and maybe once or twice this year. So I think we're safer on a lot of fronts. I think where the excess is built up is the government debt and then the non-financial corporate debt. So I think generally we're probably safer, but not completely. I guess also think about where the capital moved. When the banks couldn't make the loans as easily anymore, people still want loans. So they went to non-bank loans. So private equity shops, hedge fund shops that aren't regulated the same way. A lot of the people who work there maybe didn't go through '08. What's going to happen when we hit the next recession and you have a lot of entities who have a lot of liabilities and maybe don't have the experience or the regulatory supervision? So I think that's another area where we might have a few surprises.
I'm very sympathetic. I would have said we're absolutely safer for exactly the same shocks that you mentioned, but for what the next version of shocks is, it's a little bit less obvious. I think it's important to distinguish between systemic and risk and just lots of leverage that could cause people to lose money or even potentially cause a recession. I think the non-financial debt buildup is there. It has the possibility of being one of those things that could cause a slump. It seems harder for me initially to think about it being the same systemic effect, but the less regulated, unregulated financial system, you know, those crazy entities that only have one page of disclaimers.
Yes, I know. Touche.
I mean, but I think this also ties to Mike's point about the phrase fintech versus financial engineering. There are lots of different ways to get something that looks a lot like leverage, but doesn't always at first glance appear to be leverage to whoever's inspecting the books. And I think that therein lies the issue, is that whatever is going to be the problem might not be something that we identified very clearly the last time around.
Okay.
Yeah, I'd echo the comments earlier. I think the banks are not only better capitalized, they are more liquid, they have more stable funding. And I'd also say that the non-bank or the shadow banking sector is either better regulated or out of non-existent parts of it. So you no longer have large standalone investment banks like Lehman Brothers, for example, that were basically unregulated. The money funds now have faced some regulation. They were a big source of systemic risk. So I do think that the financial system itself is much more sound. I'd agree with we're getting a little concerned about corporate debt. I don't see that as like a financial crisis risk. I do think that in the next downturn, that could be a headwind to a speedy recovery afterward.
It sounds like most of you were answering that question in a domestic sense. And you could argue that the last crisis was sort of a North Atlantic crisis, US, Europe. I don't want to overdo it. I don't think Canada really suffered that much. But what about Europe? Is Europe safer than it was a decade ago?
No, I'm already thinking about what I want to write at the end of the year, because EMU will have its 20th anniversary on January 1st. And I was in London when the EMU started, when the euro was born. I was one of those people that did all the arbitrage trades between the Italian lira and the Spanish peseta. It was a lot of fun. Lots of currencies. It was definitely more fun. I do think, I mean, Europe, when you take it as a whole, the size of the economy is close to the United States when you put it in aggregate. So it can have a meaningful impact on the global economy. And I think it's a low probability, but when you look at things like the Italian government with its troubles, the Swedish government possibly with a political shift this weekend, Angela Merkel holding on to her coalition government by the fingernails, and if Turkey were to let immigrants back in, that could be a tipping point for her. I mean, there's a lot of weaknesses there, not to even mention Brexit and the impact that may or may not have on the rest of Europe, probably more in the UK, but at some point next year. So I do think there's some vulnerabilities there, and as the IMF always says, fix your roof while the sun shines. They haven't fixed their roof enough. They've still got some serious holes in the roof. And I worry that as we lose demographically the leaders that understood why EMU was built, you know, EMU is a political construction to keep them safe and out of war. And as those people die and you don't have that memory, the populace doesn't care as much about the project. So would they be more willing to consider a breakup because it means something different to them? So I do think there's relatively greater risks around Europe, both kind of politically and socially the next time around. And then China, I mean, you think about China's integration in the global economy today, and it's just continued to grow over the last 2 decades. If China hits a pothole, we're all going to feel it more than we ever did before. The correlation between Chinese and US stocks, while it's certainly not perfect, has been trending higher since they joined WTO. We used to not care about Chinese PMI. Now we look at it as much as we look at US. So I think an overseas trigger for a global recession is a much higher probability today relative to what it's been in the past, personally.
Great. Seth, I think this question is in some sense directed to you because you spoke about trade as being a serious source of risk for the US economy near term, but you distinguish between China-related issues and everybody else. And this question is about Canada and the US. If you can't reach a deal soon on extending the Mexican agreement to Canada and having a new NAFTA in some sense, what's the implication for the US and for Canada?
Yeah, so my baseline view there is if Canada doesn't get to yes to the bilateral agreement, such as it is between the US and Mexico, that will not trigger the abrupt end of NAFTA. Instead, it will push off the negotiations for another bit of time, and then our baseline view is that something looking very similar to the status quo ante comes out in about a year, because the differences just aren't really that big. So from a macro perspective, we don't actually think there's going to be that much of a difference. Okay. If you actually got to the point where NAFTA was completely torn up and we went back to having tariffs against Canada like the tariffs we have against China, which to me sounds absolutely implausible politically as much as anything else, I mean, that's just disastrous for the US economy. The amount of cross-border trade is mammoth, and throwing a 25%, 30% wedge into all of that is just staggering.
Okay. Next one's about the fiscal policies of the last year or so. Mix of tax cuts and expenditure increases. Most of this started 9 months ago. That's still short term, but what are we seeing as the impact today, and what do you expect the impact going forward?
I mean, in terms of the tax cut or the Tax Act, we think the impact is about so far as expected, which is to say, we thought the most notable thing would be it would increase consumer spending because it was about a $120 billion reduction in the federal tax burden on the household sector. And almost on cue, you saw in the second quarter consumer spending galloped ahead at about a 4% pace, and it looks like it's doing pretty well in the third quarter as well. We'd expect going forward that increment to consumer spending growth will kind of dissipate. Then the other big element of the tax cut, or the Tax Act, what you want to call it, whether it's a reform or a cut, people debate, was a big reduction in corporate taxes as well as a change in how other elements of the tax code, including the treatment of depreciation credit. And we were expecting that would have a pretty marginal impact on positive, but small impact on investment spending. It's hard to tease out exactly, how much that's affecting things. So far, the big lift to capital spending in the first half has been in the oil and gas sector, which we think is probably unrelated to the tax reform. But we would say so far it looks like it's doing what we thought it would do, which is add to growth this year about a little less than 0.5%. In terms of the other element of fiscal policy, the Bipartisan Budget Act, which went into effect in February, we were thinking that would start to show up in the data and in the economy in the third quarter. So far, we haven't really seen it in a tangible way, so maybe it's yet to come later in the year.
Okay, great. I think the first question is really about the technology competition between China and the United States. China's unusual in a lot of ways, but one way which is unusual is that it has companies that are at the technology frontier despite having a relatively low per capita income compared to wealthy advanced economies. So how do you see that frontier technology competition playing out over time?
I went over to China in July this summer to meet with folks and just spend time on the ground and talk to people, because you can read and you can talk to experts when they're visiting here, but I always think you get something from going on the ground. I think my favorite day there was in an area called Wuxi, which is about 3 hours west of Shanghai, at some high-tech, I'm probably mispronouncing it, I'm sorry, at a high-tech manufacturing plant. And it was like the global supply chain right in front of me. You had Korean chemical inputs, Japanese robots, Chinese workers producing auto bumpers, spoilers, grills for BMW, Mercedes, Land Rover, GM for sale in China. And they have auto production facilities here in South Carolina, in Detroit, in Mexico with American workers. Again, I think the technology push there, the Chinese government, just think every government leader has the same goal. They want to stay in power. And how do you keep in power? Well, you make the population happy. How do you make the population happy? You make sure there's money in their wallets and that they have a better quality of life. So in China's case, if government debt has grown so large that the government can't simply keep churning out money to get the growth, and you don't have the demographics there, technology is another tool they can use to support the economy and keep the growth so the population is happy. Therefore, President Xi can be leader for life. Well, it's effectively what he's doing, or could do if he chooses. So technology is an important economic tool for them. It's interesting, I was looking, I know, Kim, that you are the Japan expert in the room, but I was looking at the trade war in the 1980s, and it was interesting to me that in 1983, President Reagan instituted our own industrial policy to improve our technology, which was called Project Socrates. So we're saying China shouldn't be allowed to have a technology industrial policy to help their own domestic economy, and yet we did the exact same thing a few decades ago because we were afraid at the time that Japan was going to take over and that we might be at risk from the Soviet Union. So those two fears caused us to do something quite similar to what China's doing today. I think the difference with China and the US right now, with the bat versus the fang, there's pros and cons. We have a culture of innovation. We have a deeper research R&D culture and bench, which is obviously a huge positive for us. They have less government regulation and no privacy rules. So if the government says, I want all your data so I can look at it and try to get smarter off it, they have that advantage. So I'm not sure where it ends, but I'm happy to be looking for opportunities to invest in Chinese technology, just like I'm happy to look for opportunities to invest in US technology.
Great, okay. This one's also a long-run view. How do you see the economic policies of the current administration affecting climate issues, and what do you think it means for future generations?
So my general take on these things is two interrelated things are really, really bad for the climate. Unregulated economic activity, because if there are ever externalities, they tend not to be internalized unless there's some sort of government force to do so, and we're seeing a rollback in that sort of regulation. And then, so that is regulatory policy as much as economic policy. I think for the other part, though, just the general economic policy, if you're not creating all the right incentives for technological innovation, that sort of thing, which are the sorts of, in my view, solutions that could curb the longer run climate issues. If instead you're going for short-term gains because of short-term stimulus, you're probably slowing down the process of getting that technological innovation to get there. I guess I would have thought the first is probably worse, sort of just the outright degradation of environmental controls, unfettered economic activity that's not internalizing the longer term cost. But the other probably matters somewhat and is a bit more pernicious.
Great.
I'll say something hopeful. I think that the private, I'm saddened to see what's going on with policy around the climate in the US personally. I'm not speaking for my firm, but I am encouraged hugely by the amount of private sector corporate activity that's going towards having greener businesses, more sustainable businesses. And I think as long as that aggregate private sector activity continues and grows, that this is maybe a setback, but not necessarily a game changer, especially if it's short run.
Okay. We're seeing a number of the questions pop up again, but here's one that's sort of interesting. Do you have the sense right now that virtually all asset classes are expensive today?
Venezuela's cheap, man.
Compared to what?
Yeah, I wouldn't buy it. Sometimes things are cheap for a reason. Equities, if a lot of people will talk about cyclically adjusted price earnings ratios, Shiller's CAPE. And if you look at that metric today, it would suggest US stocks are very expensive. We're at the highest CAPE, if you will, cyclically adjusted PE ratio that we've seen since I think around 2001. It was quite a bit higher at the peak of the dot-com boom, quite a bit. So we're not at unprecedented levels, but we're high. But again, it kind of goes back to intuition. If we're this late in the cycle and we've had years of economic growth and we have strong corporate profits, you would expect that valuations could go up. So yeah, they're expensive, but they're expensive for a reason. We look at valuations as a predictor for equity returns, and over a 12-month or even 24-month view, it has zero telling power. Over a 5-year or 7-year view, valuations today, when they get extreme, tend to correlate with longer-term returns because if you're late in the cycle, the probability is you're going to have a recession in there, which is going to impact your returns for a few years. So your average annual return over that period will be lower. So I think it's fair to look for lower equity returns over the next 5 years because it'll be a recession in the mix. Is every asset class expensive? I mean, equities globally are more correlated, so they're all a little more expensive. And you want to be careful looking for the outliers in emerging markets for some of the reasons we already discussed.
One thing I would just add into that, what's hard, PE ratios, you're always going to be discounting earnings by something, and it's usually something like 10-year treasury or some sort of longer-term safe interest rates. And there, I think the jury is still out as to what the long-run level is. But if you take the Fed at face value, they think their long-run equilibrium level of the federal funds rate is about 2.75%. And then the term premium that Mike alluded to before, sort of the extra bit of interest that tends to accrue to the longer term yields relative to short term yields, that's just been trending down over the past 40 years, literally. So for the sake of argument, say that the new equilibrium value for that is something like 30 basis points or 40 basis points, not the 120 that it was before. And then you add those together, 30 plus 275 is 305, and then you keep in mind that more often than not, the short-term interest rate is a little bit below equilibrium rather than above. If 3% is in fact the new long-run equilibrium 10-year or perhaps something lower, then I think what people are used to in terms of valuations looks a bit different because you're going to be discounting by something much lower.
Agreed.
Okay. So I think this will be the last question. We've talked about a variety of political and let's call it geopolitical risks. Talked about Argentina. We talked about trade policy. Are there other political, geopolitical risks that you would want to put on the list for people to think about? And Turkey, obviously.
I'm not a European expert, but Italy worries me. I focus on the U.S., but that is something that concerns me. I still think the European currency union is fundamentally unstable.
So I worry about what I started calling the convexity of political economy. So bad economic policies often lead to bad economic outcomes, but bad economic outcomes cause people to be afraid, worried, and insular, which tend to lead to bad electoral outcomes, which tend to lead to bad policy, which tend to lead to bad economic outcomes, which tend to lead people to be afraid and insular and defensive. And that, for me, is the kind of cycle that really starts to worry me because it's hard to know why and when that spiral stops.
And I touched on it a little bit, but it feels like this isn't a U.S. phenomenon, but a global phenomenon, a sense of, and this gets to your fear and insularity, but the unease around technology and globalization and that backlash, creating a fear of foreign anything, foreign trade, foreign people, foreign workers. And if you look at the demographics of the world, that's not going away. So where does it end? We're not having as many babies in the West, and China has a slowing demographic. Their working population is shrinking. So how do we get out of this feedback loop that Seth just described? It's a longer term issue. It doesn't affect your investments today, but it's out there, and I don't see policy being focused on it as much as it should be.
I think it's a great point. And if you look at what standard demographic projections look like, more than 90% of all the population growth on the planet in the rest of this century will be in Africa. And people really just don't seem to know those basic facts. So it's a big deal. So I hope you'll join me right now in thanking our panelists. And we're just putting up for you on the screen the 4 additional events that are going to occur that the center is sponsoring this semester. So we hope you'll join us for at least some of them. The next one that's coming up on Friday the 21st, the second annual David K. Backus Memorial Lecture. Darrell Duffy, who's a distinguished Stanford professor, is going to talk about a topic that I think will find some interest, no longer too big to fail. So hopefully we'll see some of you there. Thank you very much for coming today.
I look up for that.